Alright, it's time for some more CFA reading. Alright, let's get to it. Rating 49, Equity Valuation Concepts and Basic Tools. Learning outcomes. The candidate should be able to evaluate whether a security, given its current market prices and value estimates, is overvalued, fairly valued, or undervalued by the market. Describe major categories of equity valuation models or methods. And describe regular cash dividends. Wait, let me... Extra dividends, stock splits, reverse stock splits, and share repurchases. Describe dividend payment chronology. Explain the rationale for using present value models to value equity, and describe the dividend discount and free cash flow to equity models. Calculate the intrinsic value of non-callable, non-convertible preferred stock. Calculate and interpret the intrinsic value of an equity security based on the Gordon or the constant growth dividend constant model, or the two-stage dividend discount model as appropriate. Identify characteristics of companies for which the constant growth or the multi-stage dividend discount model is appropriate. Explain the rationale for using price multiples to value equity, how the prices to earnings multiples relates to the fundamentals, and the use of multiples based on the comparables. Calculate and interpret the following multiples: price to earnings, price to an estimate of operating cash flow, price to sales, and price to book value. Describe enterprise value multiples and their use in estimating equity value. Describe asset-based valuation models and their uses in estimating equity value. Explain advantages and disadvantages of each category of valuation model. Introduction. Analysts gather and process information to make investment decisions, including buy and sell recommendations. What information is gathered and how it is processed depends on the analyst and the purposes of the analysis. Technical analysis uses such information as stock price and trading volume as the basis for for investment decisions. Fundamental analysis uses information about the economy, industry, and company as the basis for investing decisions. Examples of fundamentals are unemployment rates, gross domestic product growth, industry growth, and quantity and growth in company earnings, whereas technical analysts use information to predict price movements and base investment decisions on the direction of predicted changes in prices. Fundamental analysis use information to estimate the value of a security and to compare the estimated value to the market price, and then base investment decisions on that comparison. So we have actually talked about these concepts before, but let's just keep going. Estimated value and market prices. By comparing estimates of value and market price, an analyst can arrive at one of three conclusions: security is undervalued, overvalued, or fairly valued in the marketplace. For example, if the marketplace price of an asset is $10 and the analyst estimates the intrinsic value is at 10, logical conclusions that security is fairly valued. If the security is selling at 20, then security will be considered overvalued. If it's 5 and it's undervalued. Basically, by estimating the value, the analyst is assuming that the market price is not necessarily the best estimate of intrinsic value. If the estimated value exceeds the market price, the analyst infers to the security is undervalued. If the estimate overpriced, and it is fairly valued or overvalued. Okay. In practice, the conclusion is not so straightforward. Analysts must cope with the uncertainties related to model appropriateness and the correct value of inputs. And analysts' final conclusion depends not only on the comparison of the estimated values of the marketplace, but also the analyst's confidence in the estimated value. One can envision a spectrum running from the relatively high confidence in the valuation model and its inputs, and relatively low confidence in the convergence of the market price of the intrinsic value over the investment time horizon. Relevant to objectives of the portfolio must also be taken into account before an analyst acts on apparent mispricing or makes a buy, sell, or hold recommendation. The ability to benefit from identifying a mispriced security depends on the market price converging to the estimated intrinsic value, and seeking to identify mispriced and attractive investments. Analysts are treating market prices with skepticism. because once again, markets are not allocatively efficient, and the efficient market hypothesis is not applying in the world, so there are inefficiencies in the world. So assets can be underpriced, overpriced, or fairly priced. Analysts often use a variety of models to interpret and to achieve greater confidence in their estimates of intrinsic value. The use of more than one model and a range of inputs also helps an analyst to understand the security sensitivity of value estimates to different models and inputs. Okay, so major categories of equity valuation models: the present value model. The model estimates the intrinsic value of security as the present value of the future benefit expected to receive from the security. The multiplier model. The model are based chiefly on the share price multiples or enterprise value multiples. The former model estimates intrinsic value of the common share for the price multiple for some fundamental variables such as revenues, earnings, cash flows, or book values. Enterprise value. Okay, so enterprise value is quite an interesting concept. As when you buy a company, what is the company's worth? So if I buy a company, the company has I buy a company for $1 million, let's say. And if the company also has $1 million in savings, then I literally bought the company for free, right? Now, if I bought a company for $1 million, but the company has 0 in savings and $1 million in debt, that basically means I have to buy another $1 million to pay back the company's debt. So that's the idea of enterprise value. Multiples have the forum, enterprise value, 2 possible choices of the denominators of earnings. Yeah, so enterprise value is actually quite, it's not a straightforward concept, okay? It's a little bit of thought, okay? Asset-based valuation models. The models estimates intrinsic value of a common share of an estimated value of the assets of the corporation minus the estimated value of the liabilities of the preferred shares. So yeah, this is how much the asset are worth. As already mentioned, many assets analysts use more than one type of models to estimate value. Analysts recognize that each model is a simplification of the real world, and that there are uncertainties related to model appropriateness and inputs in the models. The choice of the models will depend on the availability of information to input the models. And the analyst's confidence in the information and in the appropriateness of the models. Yes, quite makes a lot of sense. As you begin to study of specific equity valuation models in the next section, you must bear in mind that any model is of value is by necessity a simplification of the real world. Never forget this simple fact. You may encounter models much more complicated than ones discussed here, but even those models will be simplifications of reality. Present value model, the dividend discount model. Present value model follows a fundamental tenet of economics, which states individuals defer consumption. That is, they invest for the future benefits expected. Individuals and companies make an investment because they expect thereby to earn a rate of return over the investment period. Logically, the value of an investment should be equal to the present value of the expected future benefits. For common shares, an analyst can equate benefits to cash flows to generate cash flows to be generated by investments. The simplest present value model of equity valuation is the dividend discount model, the DDM, which specifies cash flows from a common stock investment to be dividends. The next section describes aspects of dividends that users of dividends discount models should understand. Dividends backgrounds for dividend discount models. Generally, there are 2 sources of returns from investing in equities. The dividends and the changes in market prices or the appreciation. A dividend is a distribution paid to shareholders based on the number of shares owned, and a cash dividend is a cash distribution made to a company's shareholders. Cash dividends are typically paid out regularly as known intervals. Such dividends are known as regular cash dividends. By contrast, extra dividends or special dividends are dividends paid by a company that does not pay dividends on a regular schedule, or a dividend that supplements the regular cash dividends with an extra payment. The payment of dividends is not a legal obligation. Dividends must be declared or authorized by the company's board of directors. In some jurisdictions, they must be approved by shareholders. Regular cash dividends are customarily declared and paid out quarterly in the U.S. and Canada. And and in some countries annually, in some cases such as China. 中国! Okay, dividends discounted model addresses discount expected cash dividends, a stock dividend, also known as a bonus issue of shares, is a type of dividend in which a company distributes additional shares for its common stock, typically 2 to 10% of its shares then outstanding. A stock split is when you increase the number of shares by decreasing the price of the shares. So like a $10 share could be split into two $5 shares. So the value of the share remains the same. Percentage increases and decreases remain the same. Dividend percentages is the same, but it's just the number of shares is bigger, and the share price is cheaper, so that newer investors could be incentivized and has an easier time buying into the share, or incentivizes investing. A reverse stock split is when multiple shares are combined into one. A share repurchase or a share buyback is when a company buys back a share to decrease the demand and to increase the price of the share. Now, this could be done because executives are compensated for benefits or increases in share prices, or it could be done to benefit the shareholders and so these are just some terminologies. Investopedia will help you out. It's very important that you know this, because buyers of a company's shares on the ex-dividend date are no longer eligible to receive upcoming dividends. All else being equal, at the day of the company's share price immediately decreases by the amount of the foregone dividends. Exhibit 2 illustrates the decrease in the share price that occurs for a hypothetical company that has declared a $1 per share dividend as trading begins on an ex-dividend date. Yeah, so dividends may cause declines or sharp declines in stocks, at least in the short run. The dividend discount model of descriptions, and if the issuing company is assumed to be going to be a concern, the intrinsic value of the shares is the present value of the expected future dividends. If a constant required rate of return is also assumed, that DDM expression for the intrinsic value of a share is equation 1. At the shareholder level, cash received from common stock investment includes any dividend received and the proceeds of the shares that are sold. If an investor intends to buy or hold the shares for a year, the value of the share today is the present value in the two cash flows, namely the expected dividend plus the expected selling price in 1 year. Repeated this process, we could find the value of end holding periods and the present value of the expected dividends for the end periods plus the present value of the expected price in the end periods. Okay. Extending a holding period and into the indefinite future, we can say that a stock's estimated value is the present value of all expected future dividends, as shown in equation 1. Considerations of an indefinite future is valid because businesses establish a corporation are generally set up to operate indefinitely. This general form of DDM applies even in the case in which the investors have a finite investment horizon. For that investor, stock value today depends directly on the dividends and the investors expects and on the dividends the investors expect. Okay. How is the required rate of return for use of present value model estimated? To estimate the required rate of return on a share, the frequently uses the capital asset pricing model, or the CAPM. And here is the equation. Preferred stock valuation, general dividend discount models are relatively easy to apply to preferred stock. And is this in its simplest form? A preferred stock is a form of equity, generally non-voting, that has priority over common stock in the receipt of dividends and in the issuer's asset. In the issuer's assets in the event of the company's liquidation, and may have a stated maturity date in which time payment of the asset It may have a stated maturity date in which the time payment of the stock's par or face value is made, or it may be a perpetual with no maturity date. Additionally, it may be a callable or convertible. For a non-callable, non-convertible, perpetual preferred a share paying a level dividend D, and assuming a constant required rate of return over time, equation 1 reduces to the formula of the present value of perpetuity, and its value is as such. Yes. Preferred stock issues are frequently callable or redeemable by the issuers at some point prior to maturity, often at par value or at prices in excess to the par value that decline to par value as maturity date approaches. Such calls options tend to reduce the value of preferred issues to an investor because the option to redeem will be exercised by the issuer when it is not the issuer's favor to ignore when it is not. For example, if the issuers can redeem shares at par value that would otherwise trade above par value, the issuer has motivation to redeem the shares. Preferred stock issues can also include a retraction option to enable the holder of the preferred stock to sell the shares back to the issuers prior to maturity. On prospectified terms, eventually the holders of the shares has put options similar. Such put options tend to increase the value of the preferred issues in an investor because the option to retract will be an exercise by the investor, which is in the investor's favor. It ignores when it is not, and thus it benefits the company. The golden growth model, a rather obvious problem when one is trying to implement equation 1 for common equity, is that it requires an analyst to estimate an infinite series of expected dividends. To simplify the process, analysts frequently make assumptions about how dividends will grow or change over time. The Gordon or constant growth model is a simple and well recognized DDM. The model assumes dividends grow indefinitely at a constant rate. Because of its assumption of a constant growth rate, the Gordon growth model is particularly appropriate for valuing the equity of dividend-paying companies that are relatively insensitive to business cycles in a mature growth phase. Examples might include an electronic utility service serving a slowly growing area, or a producer of staple food products, e.g. bread, a history of increasing the dividend at a stable growth rate. In another practical criteria, if the analyst believes that the pattern will hold in the future. With a constant growth assumption, equation 1 can be written as equation 8. If required return R is assumed to be strictly greater than return of G, then the square bracket terms of equation 8 is the indefinite geometric series. The sum to such amount substituting into equation 8 produces the Gordon growth model as presented in equation 9. For an illustration of expression, suppose the following. Okay. An analyst might be dissatisfied with the assumptions for many reasons. The equities being examined may not currently pay a dividend. The Gordon assumption might be too simplistic to reflect the characteristic of the companies being evaluated. Some alternatives to using the Gordon model are as follows: the use a more robust DDM that allows for varying patterns of growth. Use of cash flow measures other than dividends for valuation purposes. The use of other approaches such as a multiplier method to valuation. Apply a DDM is difficult if the company is being analyzed is not currently paying a dividend. A company may not be paying a dividend if the investment opportunities of the company are also attractive, that the reintention of reinvestment of funds is preferred from the return prospect and the distribution of dividend to shareholders. The company in such a shaky financial situation cannot afford to pay dividends. An analyst might still use the DDM to value such companies by assuming that dividends will begin at some future point in time. The analyst might further assume that the constant growth occurs after the date and use the growth Gordon model. multi-stage dividend discount model. Multi-stage growth models are often used to model rapidly growing companies. The two-stage DDM assumes that at some point the company will begin to pay dividends that grows at a constant rate, but prior to that time, the company will pay dividends that are growing at a higher rate than can be sustained in the long run. That is, the company is assumed to experience an initial finite period of high growth, perhaps prior to an entry of competitors, followed by an infinite period of sustainable growth. The two-stage DDM thus makes use of two growth rates: a high growth rate for an initial finite period followed by a low sustained growth rate into perpetuity. The Gordon growth model is used to estimate terminal value at time n that reflects the present value of at time n of the dividends received during the sustainable growth period. Okay. The DDM can be extended to as many stages as deemed appropriate. For most publicly traded companies, practitioners assume growth will ultimately fall into three stages: growth, transition, and maturity. This assumption supports the three-stage DDM, the use of three-stage DDM, which makes use of three growth rates: a high growth rate for an initial finite period, followed by a low growth rate for a finite second period, followed by a lower sustained growth rate into perpetuity. One can make the case that a three-stage DDM would be most appropriate for a fairly young company, one that is just entering the growth phase. The two-stage DDM would be appropriate to estimate the value of an older company that has already moved through its growth phase and is currently in the transition phase. However, the choice of a two-stage DDM need not rely solely on the age of a company. Long-established companies sometimes manage to restart above average growth through, for example, innovation, expansion to new markets, or acquisitions. Or a company's long-run growth rate may be interrupted by a period of subnormal performance if growth is expected to moderate in the first case, or improve in the second case towards long-term growth rates. A two-stage DDM may be appropriate. Thus, we choose a two-stage DDM to value a wrong performance in example 10. Yes. Wow, look at that. Okay. Multiplier models. The term price multiplier refers to a ratio that compares the share price with some sort of monetary flow or value that to allow evaluation of the relative worth of a company's stock. Some practitioners use price ratios as a screening mechanism. If the ratio falls below a specific value, the shares are identified as candidates for purchase. And if the ratio exceeds a specified value, the shares are identified as candidates for sale. Many practitioners use ratios when examining a group or a sector of stock and consider the shares for which the ratio is relatively low to be attractively valued securities. Price multipliers are used by security analysts to include the following: the PE ratio, the price to earnings ratio, the price to book ratio, the price to sales ratio, the price to cash flow ratio. The common criticism of all of these multipliers is that they do not consider the future. The criticism is true in the multiple of it's calculated from trailing the current value of the advisors. Practitioners seek to counter this criticism by a variety of techniques, including forecasting fundamental values, the advisors 1 or more years into the future. The resulting forward or leaping or prospective price multiples may differ markedly from the trailing price multiples. In the absence of an explicit forecast of fundamental values, the analyst is making an implicit forecast of the future when implementing such models. The choice of price multiples, a trailing or forward, should be used consistently for companies being compared. Besides the traditional price multiples used in valuation just presented, analysts needs to know how to calculate and interpret other ratios, such as ratios included those used to analyze business performance and financial conditions based on data reported in financial statements. In addition, many industries have specialized measures of business performance that analysts cover covering those industries should be familiar with in analyzing cable television companies. For example, the ratio of total market value of the company to the total number of subscribers is commonly used. Under the common measure is revenue per So these are just some relationship among price multiples, present value models, and fundamentals. Price multiples are frequently used independently of present value models. One price multiple valuation approach, the method of comparables, does not involve cash flow forecasts or discounting the present value. A price multiple is often related to fundamentals through a discounted cash flow model. However, such as the Gordon growth model, understanding such connections can deepen an analyst's appreciation of the factors that affect the value of a multiple, and often can help explain reasons for differences in multiples that do not involve mispricing. The expressions that are developed can be interpreted as the justified value of a multiple, that is the value justified based on fundamentals. Justified for PE estimates can be sensitive to small changes in assumptions. Therefore, analysts can benefit from carrying out a sensitivity analysis as shown in Exhibit 6, which is based on example 12. Exhibit 6 shows how the justified forward PE varies with changes in estimates for the dividend payout ratio, or the columns, and return on equity, the dividend growth rate, or the rows, changes because of changes in the retention rate, or 1 minus the payout rate of the ROE, the return on equity. Recall ROE, G equals ROE times retention rate. The method of comparables. The method of comparables is the most widely used approach for analysts reporting valuation judgments on the basis of price multiples. This method essentially compares relative values estimated using multiples, or the relative values of multiples. The economic rationale underlying the method of comparables is the law of one price. Is the one of one price. Identical assets should sell for the same price. Yes, identifying the individual companies or even the industry as a comparable may present a challenge. Many large corporations operate in several lines of business, so the scale and scope of the operations can vary significantly. When identifying comparables, the analyst should be careful to identify companies that are most similar according to number of dimensions. These dimensions include, but are not limited to, the size, production lines, growth rate, the type of analysis. Shown in section 5.1 relates multiples to fundamentals, is a productive way to identify the fundamental variables that should be taken into account in identifying comparables. Illustration of valuation based on price multiples. Telefónica S.A., a world leader in telecommunications sector, provides telecommunication information and entertainment products for services in Europe, Africa, and Latino America. It has operated in its home country of Spain since 1924, but as of 2008, it has more than 60% of its business outside of its home market. Deutsche Telekom AG provides, so this is just examples of, price markets. Time series analysis of all price multiples, and Exhibit 8 suggests that both companies are currently attractively valued. For example, 2008 price to revenue ratio, PR ratio, is 1.3 for Telefónica, is below 2006 to 8 average, and is the ratio approximately 1.6. The 2008 PCF is 3.0 for Deutsche Telekom, and is above in 2006 to 8 average is approximately 4. The comparative analysis produces somewhat mixed result. The 2008 values for Deutsche Telekom for the PR, PCF, and PB multiples are lower than the Telefonica The results suggest that Deutsche Telekom is attractively valued when compared with Telefonica. The 2008 PE for Telefonica, however, is much lower than Deutsche Telekom. And analysts investigating these contradictory results. 他一直讲这些干嘛？我觉得他讲这些真的没有用他这个课本应该要写的比较好。In summary, the major advantages of using price multiples is that they allow for relative comparisons, both cross-sectional and in time series. The approach can be especially beneficial for analysts who are assigned to a particular industry or sector and need to identify the expected best performing stocks within the sector. Price multiples are popular with investors because the multiples can be calculated easily, and money multiples are readily available from financial websites and newspapers. Caution is necessary. A stock may be relatively undervalued when compared with its benchmark, but overvalued when compared with an estimate of intrinsic value as determined by one of the discounted cash flow methodologies. Furthermore, differences in reporting rules among different markets and in choosing accounting methods can result in revenues, earnings, books, values, and cash flows that are not easily comparable. These differences can in turn result in multiples that are not easily comparable. Finally, the multiples of cyclical companies may be highly influenced by current economic conditions. Enterprise value, we actually talked about this briefly. Alternative to estimating the value of equity is to estimate the value of the enterprise. Enterprise value is most frequently determined as market capitalization plus market value of preferred stocks. Stocks plus market value of minus cash and investments. Enterprise values is often viewed as the cost of a takeover in the event of a buyout or acquisition or merger. The acquiring company assumes the acquired company's debt, but also receives its cash. Enterprise value is most useful when comparing companies with significant differences in capital structure. Enterprise value, EV, are multiplied widely. Multiples are widely used in Europe with EV, earnings before tax, and amortization, arguably the most common. EBITDA is a proxy for operating cash flow because it excludes depreciation and amortization. Use enterprise value instead of market capitalization to determine the multiples can be useful to analysts, even where the PE is problematic because of negative earnings. The EBITDA multiple can generally be computed because EBITDA is usually positive. An alternative is using the EBITDA and EV multiples is to use operating income. Asset-based valuations. An asset-based valuation of a company uses estimates of a market or fair value of the company's assets and liabilities. Thus, asset-based valuations work well for companies that do not have high proportions of intangibles or off-the-book assets that do have a high proportion of current assets and current liabilities. The analyst may be able to value these companies' assets and liabilities in a reasonable fashion by starting with balance sheet items. For most companies, however, balance sheet values are different from market fair values, and the market fair values can be difficult to determine. Asset-based valuation models are frequently used together with multiplier models to value private companies. As public companies increase reporting or disclose of fair value, asset-based valuations may be increasingly used to supplement present value to multiplier models and valuations. Important facts that the practitioners should realize are as follows. Companies with assets that do not have easily determinable market. Alright, let's continue this reading series. Okay. So, summary, the equity valuation model used to estimate intrinsic value, present value models, multiplier models, and asset-based valuations is widely used and serve an important purpose. The valuation model represented here are a foundation on which the base analysis and research but must be applied wisely. Valuation is not simply a numerical analysis. The choice of models and the derivation of input required skills and judgments. When valuing a company or a group of companies, the analyst wants to choose a valuation model that's appropriate for the information available to be used as inputs. The available data will, in most instances, restrict the choice of models and influence the way it is used. Complex models exist that may improve on the simple valuation model described in its reading, but before the use of these models are assumed, the complexity increases accuracy. The analyst would do well to consider the law of parsimony. A model should be kept as simple as possible in light of available inputs. Valuation is a fallible discipline, and any method will result in an inaccurate forecast at some time. The goal is to minimize the inaccuracy of the forecast. Among the points made in this reading are as follows. The analyst estimating intrinsic value is implicitly questioning the market's estimate of value. That makes more sense because the efficient market hypothesis is basically wrong. If the estimated value exceeds the market price, the analyst infers to securities is undervalued. If the estimated value equals the market price, the analyst infers the security is fairly valued. If the estimate value is less than the market price, the analyst infers the security is overvalued. Because of uncertainties involved in valuation, the analyst may require the value estimates differ markedly from market price before concluding that a misvaluation exists. Analysts often use more than one valuation model because of concerns about the applicability of any particular model. Applicability. I love that word, applicability. Yo, my name is applicability. I apply, yo. And the variability is estimated that the results from the changes in inputs. Three major categories of equity valuation models are present value multiplier and asset-based valuation models. Present value model estimates values as the present value of expected future benefits. Multiplier models estimate intrinsic value based on multiples of some fundamental variable. Asset-based valuation models estimate value based on the estimated value of assets and liabilities. The choice of model will depend on the availability of information to inputs into the model and the analyst's confidence in both the information and the appropriateness of the model. Companies distribute cash to shareholders using dividend payments and share repurchases. Regular cash dividends are a key input in dividend valuation models. Key dates in dividend chronology are the declaration dates, ex-dividend dates, holders to record dates, and payment dates. In the dividend discount model, value is estimated as the present value of expected future dividends. In the free cash flow to equity model, value is estimated as the present value of expected future free cash flows to equity. The Gordon growth model, a simple DDM, estimates the value as D1 divided by R minus G. The two-stage dividend discount model estimates value as the sum of the present value of dividends over the short-term period of high growth of the present value of the terminal value at the end of the period of high growth. The terminal value estimated using the Gordon growth model. The choice of dividend model is based upon the patterns assumed with respect to future dividends. Multiplier models typically use multipliers of the form P over measures of fundamentals of variables, or EV over measures of fundamental variables. Multiples can be based upon fundamentals or comparables. Assets based on valuation models estimates values of equity as the value of assets less than the value of liabilities. Okay. And such is reading 49. We only have 11 more chapters, or 11 more readings to the end of this. So that's reading 49. I do hope my readings have been helpful. And remember, the show notes are in the description. You guys head to Amazon to get the show notes. And we're going to get into fixed income. We're going to be getting into reading 50 in the next time. And I do hope my readings have been helpful. And I hope to see you guys next time. Don't forget to get your show notes, okay? Now, goodbye.